Thanks for reminding me. You would have seen me cry if I forgot, because as soon as you don't record something, it becomes your best class ever, right? Okay, so in order to enhance the value of the stock, they'll buy treasury stock back. They'll sit there and reacquire their own stock on the market. Okay, so what happens is you're going to sit there and reacquire that stock on the market, and that's going to decrease the supply and have the effect of increasing the price of the stock. Shareholders like it as well because now you're giving them some money back in effect when you reacquire that stock. Um, there was a lot of discussion around the time that they were talking about the Tax Cut and Jobs Act. A lot of people called it tax reform. It wasn't tax reform. It was a tax cut, essentially. And they cut the corporate tax rate from in the neighborhood of 30%, 35%. They cut it down to 20%. And part of the reason they were doing that is they're saying, well, that will mean that corporations will have more money. And when corporations have more money, they'll use that to increase wages of the employees. Well, that's not what happened. What the corporations did, they said, well, our fiduciary responsibility is not necessarily to our employees to give them higher wages. Our fiduciary responsibility to our shareholders is to increase the wealth of the shareholders. So we increase the wealth of the shareholders by taking this excess cash that we have because of the tax cut and using it to reacquire shares of treasury stock. And that's what they did. So there was a fair amount of criticism that if the government really wanted, corporations to increase wages, they would have offered a tax cut if you increase wages. How about that? Hey, if you increase your payroll by a certain percent, you get this kind of a tax cut. Would have been a more direct way to do that. But they just sort of cut the tax rate and said, well, that's going to increase wages, and it never came to pass that way. Okay, so that's probably one of the main reasons. You can see some of the other reasons here that a company might go ahead and issue treasury stock. Okay, now when we purchase treasury stock, we will obviously have to credit cash, right? Because we're taking our cash, this extra cash that we have, and we were sitting there, and we are going to use it to acquire shares of our own stock. So once those shares of stock come off of the open market, they will be a credit to cash and a debit to treasury stock. That debit to treasury stock will have the effect of being a contra equity account. It'll be against our common stock, and it'll literally reduce our shareholders' equity because now we've reacquired those shares of stock in the open market. Okay, so you take a look at this example, and we've got the stockholders' equity sitting here. We have our common shares outstanding. We have our retained earnings. I guess they didn't have any paid-in capital of excess of par with this. You don't have to. I guess this company did not. Okay, and so we sit here now, and we're going to reacquire 4,000 shares of treasury stock, and we're going to have to pay $8 per share. Now, we issued it at $5 per share, so we're actually have to reacquire it for more than we had issued it for. So if that's the case, the credit to cash is always easy here, guys. You're going to have to credit your cash for 32,000 because you are reacquiring 4,000 shares at $8 a piece, and you debit the treasury stock. Now, that treasury stock account, if you look at the next slide, okay, is going to be what? Now a subtract from my overall stockholders' equity. It's a contra, it's against my equity account because you're saying, hey, I pulled those shares back off of the market. So even though you would still be showing what? That you had these, 500,000 shares that were, or not 500,000 shares, 100 shares at $5 each for 500,000, you reacquired what? 4,000 shares. So now your shares outstanding are what? Are 96,000. And you have this what? 4,000 times $8 per share. This $32,000 subtract from your stockholders' equity. It's a contra equity account, so that now my total stockholders' equity is 668,000. And everyone could see that, okay, you got 4,000 shares of treasury stock. Question? Okay. Okay, good. Now, once we issue that treasury stock, or I shouldn't say issue, once we acquire that treasury stock, there is nothing against us reissuing it. We can go ahead and reissue those shares, okay? But the way we reissue it is going to depend on whether how we account for the reissuing is going to depend on whether we reissue it above our original cost or below our original cost. Our original cost in this example being the $8 that we had reacquired the shares for. So we're going to see that in some case we'll reissue for more than our original cost, sometimes below our original cost, and we're going to see how the accounting is going to be affected by that. Okay, so in this example now we sell 1,000 of those treasury stock. We bought 4,000. We sell 1,000 and we're going to sell them now at $10 per share. So we're selling them, as you can see here in this little note, above cost. So what happens? When I do these entries, guys, I always start out with my cash. Cash is easy. $10 per share, 1,000 shares, that's $10,000. You know you got that, right? Then what? Then the tricky part, always remember that you credit your treasury stock for the original price. Since we had originally reacquired those shares at $8, when we credit treasury stock, we use the original price, $8, times the 1,000 shares. That gives us the $8,000 for our treasury stock credit. We still need a credit to make this journal entry balance, and that credit goes to paid-in capital treasury stock. Think about it. We reacquired those shares for $8 a share, and now we're able to sell them again for what? For $10 a share. That is in effect an additional paid-in capital, but we don't call it just regular APIC. We call it APIC, and we put the label treasury stock so that everyone understands that that paid-in capital, the source of that was this price over our original reacquisition price that we reacquired that treasury stock. Okay, very important. There is no gain or loss ever on treasury stock transaction. There is no gain or loss on treasury stock transaction. It is entirely contained in the stockholders' equity section of the balance sheet. It is a purely balance sheet affected transaction. There is no income statement impact at all for treasury stock transactions. Question? Okay, so then the next situation scenario is, okay, I sell an additional 800 shares, but now I sell those below cost. So now I'm going to sell them at $7 per share when originally I had acquired them at what? $8 a share. So I'm reissuing them below the cost of reacquiring them. Again, first do your cash, 5,600. You will go ahead and credit that debit that paid-in capital treasury stock for this $800. That's the $1 per share, right? Times the 800 shares below cost. You had originally purchased them for $8. Now you're reselling them for $7. That's $1 per share times 800 shares. You debit the paid-in capital treasury stock, and you always credit the treasury stock for the original purchase price times the number of shares. Originally, we had repurchased them at $8 per share times 800 shares. That's 6,400. Now notice at this point, we still have what? If you take those two transactions together, remember we had originally credited the paid-in capital treasury stock right here for $2,000. That's that $2,000 credit right there, right? And then we just debited it for what? In this transaction, we just debited it for $8. So there's still $1,200 left in there, right? And then, of course, our original repurchase of the treasury stock. I'm not going to go back. That That first reissuance was 8,000. The second one here is 64. So we went ahead and credited those 2 times. So there's 17.6 left in the treasury stock account. Now, this is the part that's important. This is the part that gets a little bit tricky. When you go ahead and we have the remaining 2,200 shares, and we're assuming that we reissue those at below cost, okay? 2,200 times $700 times $7 is going to be 15,400. We are going to, and we debit the paid-in capital treasury stock for the amount that's left. So you're limited to that last 1,200, okay? Now, you're going to always credit the treasury stock, and to get rid of the rest of it, we'd obviously have to credit it for 17.6 to close that out. And that's simply the $8 times the 2,200 shares that are left give you the 17.6. We would need a debit to make this journal entry balance. That debit goes to retained earnings. What they're saying is that after you got done with this situation with this treasury stock, you reacquired it for 8, and then you reissued some for 10, but more of the shares went below cost such that you had completely wiped out your additional paid-in capital from when you had bought the treasury stock, from when you had bought them for $10 a share. You are in effect giving your shareholders a dividend. And even though we don't debit dividend here, it has the same effect as a debit to dividend, in that we take it out of our retained earnings and are distributing it to our shareholders. So it's like a dividend, but you don't debit account dividend. It goes comes straight out of retained earnings. But it's in effect a dividend because you reacquired these shares, and then when you reissue them for less than your reacquisition price. You are in effect distributing capital to your shareholders at that point, so they have us debit dividend. It's don't debit dividend, but it's like a dividend. They have us debit retained earnings. Okay. Question. Okay, good. If there's no questions, then I'm going to go ahead and jump us into, and there was a second Chapter 11 practice midterm, okay? And some of these questions I think we looked at, so I don't want to go through all of these because some of them are either repeats of questions we've already seen or are repeating concept, okay? But let's go ahead and let's just take a look at a couple of these. And I think it's also helpful because, again, we're going to kind of be in midterm review mode tonight, okay? So let's just take a look. And if we sell 26,000 shares at $12 per share, we would take the $12 times 26,000. And that off the top is going to be a debit to cash for 312. Okay, now you look at this question, there's not a whole lot of help in that there's a lot of choices here that have a debit to cash for 312, and you can see I've highlighted A as the correct answer. Now, what happens? We credit the common stock at par. So 1 times 26,000 is going to be a credit to common stock. And then we would sit here and say, well, if we issued them for 12 and we have what, $1 per share is the par value, then I'm going to be able to, you could basically do the subtraction. 312 minus 26 leaves 286 to go to the paid-in capital. You could do that, or you could just sit here and say, well, 12 minus 1 is what, $11 per share? And $11 per share times 26,000 would also give you the same answer, that 286,000 is what we're going to credit the additional paid-in capital for. Okay. Okay, good. I think we looked at this question last time, They tell me that the land had a market value of 84,000, just to review that again. And so we use the land as the pivot point here for how we're going to account for this transaction, because they don't give me any information about the market value of the stock. So you got to read the question carefully. If they tell you, hey, the market value of the stock, it's a readily exchanged stock, well, then you're going to have to use the market value of the stock. If they don't tell you the market value of the stock, obviously you can't use it. And they're telling you, in effect, that the market value of the land is more readily determinable. Okay, so what you're going to do is you're going to sit here and say, okay, well, if that's the case, I'm going to have to debit the land for 84. I always credit the common stock at par, which is $2 per share times 6,000. So common stock, I'm going to abbreviate that CS. I'm going to abbreviate common stock is 12,000, and then the APIC is what's left, which is the $72,000 that goes to additional paid-in capital in excess of par, the answer to this question. Okay. Again, guys, I think I said probably the easiest chapter we've had so far is chapter 11, in my opinion, okay, which is if you issue stock for 7,000 cash, you know you got to debit cash. And the par value was $100 par value. 100 times 60 shares is 6,000 to the common stock. And then you've got what? You've got the remainder that is going to go to paid-in capital in excess of par for 1,000. Okay. Let's look at this question. This one's a little bit interesting. Okay. We have what? We have 15,000 shares authorized in this example. Now, let me ask you, do I have to issue all the shares that I'm authorized? No. I'm authorized 15,000. Most companies will not issue all the shares they're authorized right out of the gate. Okay. Then what? They go ahead and they issue 10,000 shares. And even though this, these are shares, even though this problem doesn't tell you so, we now know that what? They have treasury stock of 500 shares. So from your shares that are issued, you take away your treasury stock, and the shares that are outstanding then are the 9,500 shares issued minus what you've reacquired. Those aren't issued anymore if you reacquire. I mean, these aren't outstanding anymore if you reacquired them. Okay, so you subtract that from the shares issued, and your shares outstanding are 9,500. Now, as I had said in the lecture the other day, dividends are paid on the shares outstanding. Dividends are paid on the shares outstanding. Dividends are paid on shares outstanding. A corporation doesn't pay a dividend to itself. If you have treasury stock, you're the owner of those shares. You don't pay a dividend to yourself. Okay, so 0.75 cents times the shares outstanding are going to give us this $7,125 of dividend. Okay. All right. I just want to jump to these treasury stock questions. Okay. Is there a question? There's somebody breathing.
Sorry, I was getting a paper.
Okay. No, that's all right. I just wasn't sure if there was a question. Okay. So let's take a look. And they give us this information, and they want to know what the stockholders' equity account should look like after these transactions. So first off, they issue 200 shares at $20 par value for $50 per share. So that means that they will have common stock of what? Common stock going to equal 20 times 400. So the common stock should have 4,000. The paid-in capital is going to be what? $30 per share, right? The $50 issue price minus the $20 par value means they issued that in excess of par for $30. And if we have 200 shares, 30 times 200, I guess should equal to 6,000. So that's going to be my A pick. Of 6,000. But then they tell me that they bought some treasury stock at $44 per share, and it was 75 shares. So 75 times 44 equals 3,300. $75. I mean, 75 shares, I should say, at $44 per share equals 3,300. So when I reacquire that, I didn't have to do the journal entry for this question, but let's just do it. I'm going to debit treasury stock for 3,300, credit cash for 3,300. And when I report that treasury stock, I report it where? I report it in my stockholders' equity, treasury stock, 3,300. But of course, it's going to be what? A contra to my stockholders' equity. So if you take a look, that is, and it's a little hard to see how I labeled the correct answer here because it kind of went to the bottom of the table. Okay, A is the correct answer. You have your common stock, your A pick, and then you subtract the number of shares that you're holding in treasury stock. Okay. All right, good. Select the journal entry when we purchase the treasury stock. Okay, and a good way to do this, guys, is before you get locked into looking at the choices and figuring something like that, just do the journal entry. So if it's what, $36 per share, 1,000 shares, that should be a debit to treasury stock of, am I doing my math right? 36,000? 1,000 times 36, okay? And then I simply have to credit cash for the 36,000, right? Oops. Yeah. So they purchased a treasury stock. What happened here? What did I do wrong? Huh? Debit to treasury stock. What the hell happened here? Oh, I see. Now I'm getting mesmerized by the fact that they put the B. You know, the B goes with this choice. Scared me for a minute. So that's the journal entry. B, it's trying to say B is the right answer. B is pointing up there. Okay. Question? Okay, good. So chapter 11 to me, not too hard. Okay, not too crazy. All right, so with that, unless there's a question, I'm going to jump us to chapter 12. Okay, so through the class, we kept saying, hey, 4 financial statements: balance sheet, income statement, where we spent most of our time, statement of stockholders' equity. Now we understand how retained earnings works: beginning balance plus net income minus dividends, ending balance. We understand a little bit more about stockholders' equity now, just beyond common stock. Common stock, if you issue it for more than par, you'll have an additional paid-in capital in excess of par. And if you've bought some treasury stock, that's going to be a contra to your stockholders' equity. So we've got a pretty good understanding of our balance sheet, our income statement, our statement of retained earnings, statement of stockholders' equity. But we did say, hey, there's a fourth statement. It's called the statement of cash flows. Okay. So now we're going to turn our attention to understand something about that statement of cash flows. And it is useful because it allows us to determine the ability of the entity to generate a cash flow. Okay. Now we may be interested in that because we're interested, is the company going to be able to maybe pay dividends to us at some point in time? If we're buying this stock because you're old like me and you want the opportunity for dividend, then you might be looking, hey, is there generating enough cash to pay out a dividend? Maybe you're just looking at it from a solvency standpoint. Do they have enough cash to meet their current obligations? Okay. We're going to see that we're going to have a difference between what we report as net income versus our cash provided or used by operating activities. And so the statement of cash flow is going to be very useful in that it's going to provide a reconciliation between our accrual net income and our cash provided by operations. And that's really going to be our main learning point here, is how do you figure out the difference between your net income, which is an accrual number, and your cash provided by operations, which is a cash number. And then you will have your investing and financing activities. And that's going to be pretty easy for you to understand. We'll take a look at that. Okay, so these are just high level uses, objectives of the statement of cash flows. Okay, get some light on here. Okay, all right, so now when you take a look and we prepare our statement of cash flows, we'll have operating activity, we'll have investing activity, and we'll have financing activity. Okay, and as I said, this part right here is going to really focus on the difference between net income and cash provided by operations. And these sections are pretty easy to remember. I'm going to give you some ways to remember those. Okay, and I'll give you some help with that, and those will be pretty easy. So 3 categories on the statement of cash flows: operating activities, investing activities, financing activities. Okay, now when we deal with cash flows from operating activities, we're talking about cash that is generated from the sale of goods or services, cash from dividends and interest that we received, cash outflows for inventory, for wages, for taxes, interest expense. Okay, now this is a little bit of a problem, and that we're talking about the cash that is generated by our operations, but we've learned that what? Interest is a non-operating item. Okay, and if you have what? Money you receive for a dividend, not money you paid out for a dividend, but now your company invested in the stock of another company and you receive a dividend on that, why wouldn't that be a cash flow from investing activities, And I'm here to tell you that it should be. But because we're going to start with net income and reconcile to cash provided by operations, we're going to have to take these items that are non-operating, this income from investment, this income from interest, money that is spent on interest, and we're going to have to put them up in the operating section, even though on the income statement they would be non-operating. And that happens because in our cash flows provided by operating activities, we start with net income. And so they leave us no choice than to put things that are not operating up in the operating section. And if that sounds dysfunctional, you're right, it is. It is dysfunctional. Okay, a better thing for the statement of cash flows, and I think someday FASB is going to have to make this change, would be to start with operating income and reconcile to cash provided by operations. And then they would be able to put what? Interest revenue down in the investing section, interest expense down in the financing section, and they could put dividends received in the investing section, and it would then be more logical when a user looks and sees dividends received as investing, dividends paid as financing, which we will see that dividends paid as financing because dividends don't affect net income. So they can put dividends paid don't affect net income. They can put dividends paid down in the financing section. It doesn't mess anything up. And that's where it belongs, just like dividends received belong in investing. But since they insist on starting with net income and reconciling the cash provided by operations, we have to do this weird stuff. Put our interest and dividends received in operating, our interest paid in operating activities, even though they're technically non-operating items. Okay, so we'll have our investing activities and we'll have our financing activities. And I'm going to give you an easy way to remember those here in a couple of minutes. So don't worry about these slides right now. Okay, what I want to do is come back to this. Don't worry, we'll come back to this. Okay, but I want to jump to here. Let's just start to understand this operating activity section. And you notice that what? Companies will report a net income number that is different from their cash provided by operations. And that shouldn't shock you too much in that what? We know that we don't wait until we collect the cash to recognize net income. So there should be a difference between net income and cash provided by operations. So what I want to do, and don't be distracted by this 13, guys. I call it chapter 12. This book called it chapter 13. It's chapter 12 for our purposes, okay? But I want to go ahead and I'm going to stick in a new slide here. Okay, and I'm doing it this way rather than the whiteboard because I want to give myself a little, I think I get a little more room this way. Okay, so let's just go ahead and let's start this company, okay, year one of this company. And let's say they provide a service on account. So they provide $10,000 worth of service on account. What would be the journal entry for that? That's a question. That's a question.
Can you ask it again?
Yeah, they provide $10,000 worth of service on account.
So debit cash, right?
On account.
Okay.
Accounts payable.
They provide $10,000 worth of service on account.
So that's account receivable, right?
Good. So we're going to go ahead and we're going to debit accounts receivable. $10,000. That's 10,000. And credit revenue, whatever, right? With me so far? Okay. Now, let's say this is the only transaction this company has all year. Nothing else happens. They provide service on account for $10,000. Okay. So when I prepare my, which statement do I prepare first?
Income.
Income statement.
Income statement, good. Do I have any revenue?
Yes.
Good, I got revenue of 10,000, right? Good, do I have any expenses?
No.
Expenses are 0, good. So I have net income of
10,000.
Okay, there's my income statement. How about a balance sheet? Do I have any assets?
Accounts receivable.
Good, I got accounts receivable of 10,000. Do I have any liabilities?
Uh,
Huh? Do I have any liabilities?
yes. It's
What?
the shareholder.
Shareholders is not a liability.
No,
So the revenue.
How is revenue a liability?
no liability.
My liabilities are zero. Revenue is revenue. Okay. And then I have what? Stockholders' equity. And guys, I'm not going to go through my closing entries. My retained earnings is how much? 10,000. So I close my net income to retained earnings, right? Retained earnings beginning balance plus net income minus dividend. Beginning balance was 0. Net income was 10. There were no dividends. This was the only transaction, right? So my retained earnings has a $10,000 balance in it after I do my closing entries. Does my balance sheet balance?
Yes.
Yes.
Okay, good. Now I can prepare my statement of cash flows. I'm going to abbreviate that SCF, statement of cash flows, and I'm going to have my cash provided or used by operations. That's that operating activity section. Okay, cash provided or used by operations. And I'm going to sit here and I'm going to report my net income. I always start with net income. Net income is what?
10,000.
10,000. Okay. And then I have to analyze my current items. And so when I look, the only current item here that is worthy of analysis is my balance sheet. So my balance sheet, this is at 12/31, showed 10,000 of accounts receivable. But at the beginning of the year, at 1/1, right? Beginning of the year starts January 1st, it ends 12/31. It showed 0, didn't it? Because I just started operations. So I had no accounts receivable when I first started. So I've got what? I've got an increase of 10,000, don't I? Okay. And when your accounts receivable increases, you subtract that. Subtract increase in AR. And my increase in AR was how much?
10,000.
1,000.
10,000, good. So I subtract that. And so my cash provided by ops equals 0. And that's correct. There was no cash provided by operations. Even though I showed a net income of 10,000, no cash came in. But you don't realize that until you get down here to the statement of cash flows where they start telling you, well, here was my net income, but I had to analyze my current items. And when I analyze my current items, I see that my accounts receivable increased. My account receivable increased. I subtract that from net income to derive my cash provided by operations. Okay. Now we complete year 1. Let's go into year 2. Okay. And in year 2, the only thing that happens is they collect some cash on that account receivable. So let's say, I'm just making this number up, guys, they collect, I don't know, We'll make it $6,000 cash. When you collect cash, what should you debit?
Cash,
Cash, good.
credit, accounts receivable.
Good. Credit the AR, 6,000. Good. That's the only thing that happens that year. In year 2, they just collect some cash in the account receivable. Okay. What statement do I make first?
Income,
Income
statement.
statement. Good. Do I have any revenue?
no,
No.
Revenue is 0. Excellent. Do I have any expenses?
no,
Good. Expenses are 0. Okay, good. When I prepare my balance sheet, do I have any assets?
Cash.
Good. I've got cash, 6,000. Guess I should squeeze my net income in here, guys. Sorry. Net income is 0.
would you still have 4,000 on accounts payable?
When did I have 4,000 on accounts payable?
Okay, so that just, okay, because you closed it out last year, so it would be 0.
I never had an account payable in this whole example.
No, sorry, I meant accounts receivable.
Hang on.
The-
Let me rewrite this net income here. Sorry. I'll just rewrite this net income. Just kind of mess this up. Okay, good. Net income is 0. I've got cash of what? 6,000, right? And then your question, yeah, I've still got 4,000 of account receivable, right?
Mm-hmm.
Right? I had 10, I collected 6, so I still have 4. Good. So account receivable is 4. Do I have any liabilities?
No,
Good. Liability is 0. And my retained earnings is still what?
1,000, 10,000, sorry.
Nothing changed there, right? Okay. So now I'm ready to prepare my statement of cash flows for year 2 now. And I prepare the statement of cash flows. Let's see, I guess I better have to, where am I going to write this stupid thing? I better write it over here. Year 2 statement of cash flows. This is year 2 statement of cash flows. What do I start with? What do I start with on my statement of cash flows?
Income, or net income.
Good. In the operating section, I'm going to start with net income, which is how much?
0.
0. And then I'm going to analyze my current items, right? So now, guys, this is not the best presentation. My accounts receivable went from what? From an ending balance of 10, or beginning balance, right? At 1/1 year 2. 1/1 year 2, 12/31 year 1 is the same as 1/1 year 2. So I had a beginning balance in my account receivable of what? Of 10. Now it has gone down to 4. So do I have an increase or decrease?
Decrease.
Huh?
Decrease, right?
Right. It decreased 6,000, didn't it? I ended year 1 with 10, which means I started year 2 at 10. If you end 1 year with an amount, that money's still sitting there at the start of the next year, right? All right, so it's still sitting there. I start at 1/1 with 10. I ended at 12/31 with what? 4. So it decreased 6, didn't it? So now I take the decrease in AR and I add it. I take the decrease in accounts receivable and I add that. And when I add that, I get cash provided by ops of what? I'm just gonna write this down, doesn't line up right. Of 6,000? Is that how much cash was provided by operations?
Yes.
Yeah. Okay. Okay, good. Then I get into year 3. And in year 3, nothing happens except I have a $500 expense and I pay that on credit. So if that's the case, I'm going to debit expense. How much did I say? 500? 500. I'm paying it on credit. So I'm going to credit account payable, right? When I prepare my income statement, I'm going to have revenue of 0. I'm going to have expenses of how much? 500.
500.
So I'm going to now have a what? Net loss, right? Can happen. Companies can have losses, right? Net loss of 500. I prepare my balance sheet. My cash is still what?
6,000.
Still 6,000. Good. My accounts receivable is still what? Still sitting there at?
It would be 3,500.
No. To increase an asset, you debit it. To decrease it, you credit it. If if accounts receivable had 4,000 at the end of year 2, and I neither debited it nor credited it during the year, then it still has 4,000, right?
Okay, yes.
Okay. And then I have what? I have a liability now, don't I? Of 500. This account payable. Let me just I'm just going to call it out for the liability it is. I have account payable of 500, right?
Yes.
And then I have retained earnings, but now my retained earnings is going to have to be 9,500 because when I have a loss, when I close that out, that'll reduce my retained earnings, right? So the retained earnings is now 9,500. Does the balance sheet balance? Does the balance sheet balance?
Yeah.
Okay. Okay, good. So now I'm going to prepare a statement of cash flows, and I'm going to have to kind of try to commandeer it in here. Here's my statement of cash flows now. This is year 3. What do you start with on the statement of cash flows?
Net income.
Good.
Or net loss.
Net, good, very good. Net loss in this case, 500. Right? And then I'm going to do what? I'm going to analyze my current items, and my accounts receivable did what? From year 2 to
Stayed the
year
same.
3, good. Accounts receivable stayed the same, but account payable did what? Account payable went up.
Increase.
Account payable is a current item. So when I analyze my account payable now, I'm going to go ahead and add the increase in account payable. I add the increase in account payable. Account receivable didn't change. I add the increase in account payable. And now my what? Cash used by ops is what? 0. And it's true. No cash was used by ops. Even though I showed a net income or loss of 500, no cash was used by ops because all I did was have an expense and I paid that on account. Okay. All right. So much for fitting this all in one slide. I want to keep this. Okay. And I want to put in a new slide because I want to go to year 4. We're almost there on this example. In a minute, there's going to be a payoff for this trouble that we're going to here. Okay. Really? You're going to crash on me, aren't you? God damn thing. Okay, good. It heard me. It saw that it's about to have a eruption over here. Okay. All right. So now we're going to go to year 4. Okay. And in year 4, the only thing I do is I pay that $500 account payable. That's all I do. So when I pay that account payable, 500, I debit accounts payable 500, I credit cash 500, don't I? Okay. When I prepare my income statement, my revenues are 0. It's the only transaction that happened. My expenses are 0. No, it's not 500. I'm simply paying the account payable. This is an entirely balance sheet transaction, right? I took the expense for that in year 3 when I incurred the expense. All I'm doing here is now paying that bill, that liability that does not generate an expense, right?
Mm-hmm.
So my revenue is 0, my expense is 0, my net income therefore is 0. My balance sheet now, and now I got cash, and I ended year 3 with cash of 6. I just spent 5, so I guess my cash is 5.5 now.
Yeah.
All right. Cash is 5.5. My accounts receivable is still
4,000.
people to start paying me, huh? My accounts receivable is 4,000. Right. Okay. When I get to my liabilities, my account payable is now what?
0.
Right. And my stockholders' equity
95.
is still my retained earnings good to 9,500 and the balance sheet balances, right?
Yeah.
Okay, good. Now when I prepare my statement of cash flows, I can just write it here for year 4. What do you always start with?
Net income.
Net income. Net income is 0. I analyze my current items. Accounts receivable stayed the same, but account payable did what?
Went down.
It decreased, right? It went from what? It went from 500 to 0, right? It was 500 the end of year 3, 400 the end of the year, it's 0. So it decreased. So I add, excuse me.
Subtract, right?
Thank you. I subtract the decrease in, I'm not writing this very well, subtract the decrease in AP. And now when I report cash provided by Well, actually, it'd be cash what? Used by operations, it's 500, isn't it? And when you look, yeah, $500 of cash got used by operations. So this statement of cash flow is kind of a useful document in that it shows you why there's a difference between what? Net income and cash provided by operations, okay? In our first year, the difference between net income and cash provided by operations was that I got my revenue entirely on a credit situation. So there was no cash provided by operations. In year two, even though my net income showed zero because I had collected on some revenue I had earned in a previous period, my cash provided by operations was this
6,000.
6,000, right? Good, because I collected that cash. Year three, even though my I showed a $500 loss, no cash was used, and so my cash provided by operations or used by operations was zero. And in year four, because I had paid off an expense that I incurred a bill for in the previous year, even though my net income shows zero, I did indeed use cash provided by operations of 500. Okay. So that's sort of what the thing is trying to show you. And so you can kind of see that it's explaining that difference between net income and cash provided by operations. But I am going to ask you some questions where I'm going to give you net income and I'm going to show you how some current items have changed, and you're going to have to know how to handle them. So what I'm going to do is I'm going to give you a mnemonic, and the mnemonic that you're going to use here is CLAD. Okay. Now, sometimes people get mad at me because they say, don't give me a mnemonic. Meanwhile, I have CPA students, I have practicing accountants who have been assigned, when I say practicing, kind of rookies, who've been told by their supervisor, hey, prepare the statement of cash flows. And the poor person's sitting there going, what did John Lord teach me that time? How the hell do I do this thing? Okay, so you can use this in a professional environment to figure out your statement of cash flows, because the statement of cash flows is the last statement that the accountant prepares. We first prepare the income statement, then we prepare the balance sheet. We have our stockholders' equities, stockholders' equity section down there, a statement of stockholders' equity we can prepare. Well, we'll probably prepare that second. Then we have our balance sheet, right, as we close out our retained earnings. So now we've got the three statements. So now we look at the statements that we have and we prepare the statement of cash flows. We look at the income statement. We start with net income. We write down net income. Then we analyze the current items on the balance sheet. We analyze the current items on the balance sheet, analyze your current items, okay? And now what? How the hell am I supposed to get out of this mess? Okay, analyze my current items. Don't panic, John. Analyze my current items, and for assets, do the opposite. For liabilities, do the same. What the heck does that mean? Well, let's go back and let's look. Assets do the opposite, liabilities do the same for our current items. So what happened? When my accounts receivable increased in the first year, I did the opposite. I subtracted it from net income to get the cash provided by operations. In year two, my accounts receivable went down. So what did I do? I added it to my net income to get cash provided by operations. I did the opposite. For my liabilities, I do the same. In year three, my accounts payable did what? It went up. So what did I do? I added it to net income. I went in the same direction. I added it to net income to get the cash provided by operations. In year four, When my liability went down, what did I do? I'm not the opposite, I did the same. What did I do? I subtracted it from my net income to get cash provided by operations. In my first year, or year 3, I should say, when my liability went up, I did the same, I added it. When my liability went down, I did the same, I subtracted it. So for assets, do the same. For assets, do the opposite. And for liabilities, what? Do the same. Question.
So for the assets, you stick with the original one. For example, the accounts receivable went up, so you subtract it, and then when you received the cash, it went down, so you added it.
I did
But you didn't. But you didn't do the opposite with the cash asset. That one was just left alone.
Cash is not part of the analysis. When I'm
Okay.
current items, and that's a good question. Even though cash is a current item, I'm explaining why cash changed. So I don't analyze cash to see why cash changed, right? Cash is, if you will, the dependent variable here. Okay. And so I'm trying to understand why cash changed. So you want to analyze cash, you analyze the effect of other accounts on, really you're analyzing their effect on net income to get cash provided by operations.
Okay. Thank you.
Mm-hmm. So cash is not part of the analysis. That's a good question, because I have had students have a problem with that, like on an exam. Question. Okay, now sometimes students will say, well, wait a minute, and they'll want me to go through every current asset and every current liability to prove it to them. We're not doing that. I'm telling you, current items. You have to know what your current items are. You have to know what your current assets are, your current liabilities, but it works exactly the same for every current asset, every current liability. Okay. Okay. The L stands for losses and gains. Losses and gains. Losses and gains. Okay. And for losses and gains, do the opposite. For losses and gains, do the opposite. Okay. For losses and gains, do the opposite. Now let's stop and think about that for a second. Okay. For losses and gains, do the opposite. And let's see. Yeah, okay. I'll add a new slide here. Won't hurt. And I'll put this back up. I'll put this slide deck back up with this stuff that we've scribbled all over these pages here. Assuming this whole thing doesn't crash on me. Okay. So for losses and gains, do the opposite. So let's say I have equipment that had an original cost of $1,000 and had accumulated depreciation of $300. What's the book value of that asset?
$700.
Good. $700 is the book value of that asset, right? That's what I think is value is left in that asset after we've computed some depreciation on it, right? Okay, good. Now let's say that I'm able to sell that asset for $500 cash. So I would go ahead and do what? Debit cash for 500. Debit the accumulated depreciation for what? 3. That's accumulated depreciation. That's that accumulated depreciation. I'm going to take it off the books because I'm getting rid of that equipment. I'll credit equipment for what?
1,000.
Okay, good. So do I need a debit or a credit to make this journal entry balance? I'll wait.
Sorry, I'm trying to go through it. Can you describe it one more time?
Well, these are debits and these are credits. So do I need a debit or a credit to make this journal entry balance?
Debit.
Yeah.
Good. I need a what? I need a $200 debit. And we call that debit loss on sale of equipment, don't we?
Yes.
Okay. But what happens? Cash used by operations, which is what I'm using this CLAD mnemonic for. This is how I calculate my cash provided or used by ops. I probably should have said that. This is how I calculate my cash provided or used by ops, and you can make a flashcard out of that. This is how I calculate my cash provided or used by ops, is what that horrible handwriting says. Cash provided or used by ops is CLAD, current items. Losses and gains do the opposite, because what's happening? I'm showing a loss, and a loss does what? It decreases my net income, doesn't it? Loss decreases my net income. Meanwhile, I didn't have this $200 cash wasn't used by operations. In fact, I have what? $500 of cash that came in, don't I? So what we do is up in the cash provided by operations section, we will add that loss back. We'll do the opposite. And then when we get into our investing section, we'll show that $500 cash came in because we sold off one of our investments. In this case, the investment is what? Is our investment in equipment. And we'll show that actual cash down in the investing section. Remember, we have 3 sections: operating, investing, and financing. So now we'll take that true cash that came in the 500 and show that in the investing section. And we what? We back out the effect of that $200 loss on net income by adding it back to net income. Now, if this equipment had been sold, and I'm going to use this same scenario here, but now I'm going to sell the equipment for what? I'll sell the equipment for $1,200, let's say, which would be kind of weird. But let's say this equipment is, I'll sell it for $800 because I don't want to be able to sell the equipment for more than I bought it for, because that's kind of weird. So let's say I sell the equipment for $800. Okay, now what? Well, now I'll debit cash, and these are mutually exclusive examples. I'll debit cash $800. I will debit the accumulated depreciation, again, leveraging straight off of this again, for $300, right? I'll credit the equipment for $1,000. Now I need what? Now I need $100 to make that journal entry, and that $100 is a gain. That's showing a gain. That gain is adding to my net income, but it wasn't $100 of cash that came in. It was $800 of cash that came in. So what I'll do is I'll do the opposite for losses and gains. I will subtract the gain to back off its effect on net income, but then I'll show what? I'll show the actual cash that came in. But remember, selling equipment is not a day-to-day operation, so I don't want to show that cash up in the operating. I'll show it where? In the investing section, because I generated now $800 of cash in this mutually exclusive example. I've generated $800 of cash from the sale of the investment in equipment. Okay? Okay, so gains and losses do the opposite. The A stands for always. And if I wanted to, I could spell CLAD with 2 A's. Always add, always add. So you could spell your CLAD with 2 A's, depreciation. Always add depreciation. Always add depreciation. Think about it. Again, remember, I'm starting with net income, right? And when I record the depreciation for the period, I debit depreciation expense. That's an expense on my income statement. I'm just making this number up. $200. I credit what? Accumulated depreciation. I report that on my income statement as an expense. It reduces my net income. Meanwhile, no cash went out the door. So to get cash provided by operations, start with net income and always add depreciation. Always add depreciation. CLAD. Okay, so let's go through this one more time. When you prepare the statement of cash flows, the first thing you're going to show is cash provided by operating activity. To prepare the cash provided by operating activity, you follow CLAD. CLAD says what? Analyze your current items. For assets, do the opposite. For liabilities, do the same. If the asset went up, subtract it. If it went down, add it. For what? For my liabilities, do the same. If the liability went up, add it. If it went down, subtract it. Okay, then what? Losses and gains, do the opposite. For loss, add it. For gain, subtract it. And then always add depreciation. And you look at that and say, oh, you're just telling me to memorize something. I'm telling you, this is how accountant prepares a statement of cash flows. I bet you they got a CLAD mnemonic sitting in their bottom drawer there, and when they're making the statement of cash flows, they're going through the balance sheet and they're analyzing the current items. They're sitting there and they're doing the opposite for losses and gains, and then they're always adding depreciation. At the end, they go, huh, it works. The change in cash for the period matches the actual change in cash. This works every single time. Okay. Now you come over, okay, and it turns out that there are two methods for calculating the cash provided by operating activities. In this class, we will only deal, what I just taught you is the indirect method. There's another method called the direct method, of which almost nobody uses. Okay, so you have your other financial statements, your balance sheet, your income statement that you'll be able to use, and you will use that to prepare your statement of cash flows. And almost everybody, and I don't know about these 98%, I'm completely skeptical about the percentages that these slides put on the methods that are used. It just sounds a little far-fetched that they would have that precise of a percentage, but most companies will use the indirect method. Most companies use indirect. So we're just going to focus on indirect. And when you use the indirect method, you will have your income statement in which you'll have your net income. You will have your balance sheet in which you'll calculate the changes in your current items. Okay, they're going and looking at their current items, current assets right here. I probably shouldn't have underlined those because those aren't current. You'll analyze your current items. You'll analyze your current liabilities. Okay, and then from that, you will go ahead and you will be able to prepare a statement of cash flows using the rules that we talked about. Start with net income. That came right off of the income statement. Always add depreciation. Do the opposite for losses. They had a loss, they added it. Do the opposite for your assets. Accounts receivable decreased, so they added it. Inventory increased, so they subtracted it. Prepaid expense is an asset, so they did the opposite. It increased, they subtracted it. Accounts payable is a liability. Accounts pay a bill. So what did they do? It increased, so they did the same. They added it. That gave them the cash provided by operating activities. And then you'll have these two other methods, investing and financing. Okay. And when you talk about investing and financing, where am I now? Okay, when you talk about investing and financing, I have to go back, right? Hang on back, guys. Let's go back because I kind of just jumped forward to the operating, we'll come back to this. When you talk about investing and financing, now I'm going back several slides. When you talk about investing and financing, think of it this way. And I know they give you some examples here on the slide, but just listen to what I'm saying. Think of an investing department. You have in your company an investing department. What do you tell your investing vice VP of investing to do? What do you tell your investing department to do? Not a trick question. What do you tell your VP of investing to do? Not a trick question.
Don't make a bad investment.
Well, okay, you could say that to them, don't make a bad investment. And if you told me that, I'd say, well, I quit. Don't hold me to that criteria, because some investments will be good and some will be bad. Hopefully my good ones will be better than my bad ones, right? Okay, but what do you want me to do?
Win, make money.
Okay. Most importantly, guys, what I'm looking for is you want me to invest. If you tell me, hey, you're my investment guy, you want me to make investments, some are winners, some are losers, and hopefully my winners will be more than my losers, right? Yeah, okay. But I do have to invest, don't I, if I'm in my investing department, okay? And so what am I going to invest in? I'm going to invest in what? Stocks of other companies. I may invest in the bonds of other companies, or I may take some of that investment capital and do what? Invest in property, plant, and equipment that will be used by the company in operations, right? So I can invest in the stocks and bonds of other companies, or I could invest in my own assets, my own building, property, plant, equipment, right? Okay. Now, when I make those investments, when I buy the stock, when I buy the bond of the other company, that's going to be an outflow of cash. Okay. And then what? If I sell that investment later, or I get some cash that comes in because I do what? I bought equipment, that's the cash going out. But now when I sell the equipment, some money comes in. And this is where I would show the actual cash that came in. So even though I would have done the opposite for the gains and losses, just going back to our marked up slide here, okay, the actual what? Cash that came in would show what? Would show cash that is provided by investing activities, because now I sold off a piece of equipment that I had invested in earlier. Okay, so again, you have an investing department. You tell that investing department to do what? Make investments in stocks and bonds of other companies. And you tell the investing department to do what? Make investments in our own property, plant, and equipment. That's the money going out. Money comes back in when you sell off those investments. I sell that stock, I sell that bond, the bond matures, I sell some equipment that I had bought earlier. Okay. In your financing department, for our financing activities, think of a financing department. What do you tell them to do? What does a financing department in a company do?
They finance?
They finance. What does that mean? Yeah. What does that mean?
Keep
Prepare
track.
financial statements, keep track of expenses.
No, that's the accounting department. Financing department.
I'm sorry.
Build capital.
Loans, yeah. Debts and loans. Is that what
They're going to get me financing, right?
Mm-hmm.
Yeah, I want to buy, this beautiful piece of property. Well, guess what? You don't have the cash. Okay, go get me the cash so I can buy that thing, right? So you tell the financing department to raise you capital, don't you? Okay, how do companies raise capital? They raise capital by doing what? They raise capital by
Issuing stock.
issuing stock, issuing bonds, borrowing money. And then if you issue stock, could you have to pay dividends on that? Might a company pay dividends on that?
Yes.
Yeah. So when you pay the dividend, that's cash going out, right? Now, unfortunately, for the dividends that we receive when we invest in stock, that's not in the investing section. That's in the operating section. Why? Because we started with net income, and dividends from investments is considered an income statement item. And because we started with net income, unfortunately, dividends received, and I say unfortunately because it gets hard for students to remember this, for dividends received, that's operating. Dividends paid is what? Is financing, and it's more logical that dividends are shown down in that financing section like that. And you can do that because what? Dividends don't affect net income. Dividends paid don't affect net income. Whereas my what? My dividends received do affect net income, so I'm stuck putting them up in the operating section, even though technically they are a non-operating item. My interest, revenue, and expense has a similar problem in that I have to put it up in the operating section, even though it's a non-operating item on the income statement. I have to put it up in the operating section of the statement of cash flows. Why? Because I started with net income. And remember, net income is what? Is our operating income plus or minus my non-operating items gives me net income. Okay.
But we don't have dividend received, right? We always have
Why not? Why wouldn't you receive a dividend? I invest in the equity security of another entity. So I'm Apple, and I decide, I don't think this would happen. I'm Apple, and I decide to buy some stock of Microsoft. So I'll debit investments. That's an asset. It has future economic benefit. $100, and I credit the cash when Apple buys the Microsoft stock, right? Can Apple buy Microsoft stock if they want to?
Probably as like institutional investors.
Probably, guys. Corporations do this every day. Sometimes they buy all the stock of another corporation. That's called, a merger. Companies buy the stocks and bonds of each other all the time. Apple buys the stock of Microsoft. I don't think they would because they're competitors. I'm just saying it's possible that they could. There's no hindrance to them doing that in the open market. They go and they buy the stock of Apple, right? Or whatever.
Yeah.
Apple buys the stock of Microsoft, right?
Yeah.
Okay. So then what? So then a little bit later, I forget whose stock we bought. Microsoft pays a dividend. And they pay a dividend to all their shareholders, including Apple. So what is Apple going to do? Apple will debit cash, and I'm going to make the dividend $5, and I'm going to credit dividend income, investment income, whatever, $5. Now, when I prepare my income statement, say this was the only transaction they had, they got this dividend. So they will have revenue of 0, expenses of 0, operating income of 0. Now I'm going to run out of room. And then in the non-operating section, bear with me, just pretend this kept going down. In the non-operating section, they'll show what? Dividend income of $500 So when they report net income shows what? Not 500, but $5. Net income now, this would be net income. Net income now is going to show what? Net income shows $5, right? Okay, so because my statement of cash flow starts with net income, I'm stuck with this. I've got net income of $5 and I got cash that was provided of $5. And because I start with net income, that's what I said. If I started with operating income, that would be beautiful. Start with operating income instead of net income and the cash provided by hello operations. If you start with operating income, then the number is 0. And then you can take this whole dividend income and put it down in the investing section where it belongs. But the bastards don't do that. I'm calling FASB that. They start with net income of 5. And now you have to remember that what? Well, okay, that's dividend income. And that was cash provided by dividend income. And so I'm sitting there and I don't have to do anything because this didn't affect any current item on my balance sheet. It just all came in on cash. So there's no adjustment necessary for that. Now, if I had had a situation where they hadn't paid me the dividend yet, and I debited instead of cash, I debited dividend receivable, and then I showed that in dividend income. Well, now my dividend receivable current asset would have done what? It would have gone up, and I would have subtract the increase in dividend receivable to get income provided by, or I should say cash provided by operations, which would be 0. My point in all this, and maybe beyond the scope of anything when I ask you, is that the dividend income belongs what? Up in the operating section. Interest income, cash interest income belongs in the operating section. Interest expense belongs in the income, cash provided by operating, up in the operating section. But dividends paid, when I pay a dividend, I debit what? I debit dividend, $5. I credit cash, $5. Well, dividend is not reported on the income statement. It's a subtract from the beginning balance of retained earnings. It's not on the income statement at all. So they say, okay, just go ahead. You can put it down in the, and it'd be in the financing section then, because you're paying a dividend on your own stock and that doesn't have an effect on net income. So you can put it down in the financing section where it belongs. But for dividends received, for dividend income, that's in the operating section, and interest expense and interest revenue also is really kind of misplaced up in the operating section.
Thank you very much.
Okay, so it's kind of funky. It is. And they could fix it all. Start with operating income. Come on now. It's not that hard. Go ahead. You can do it. Start with operating income. Everybody knows what operating income is. Just start with that and save us. Just think, we'd be in bed right now if it weren't for this. Okay. All right. So with all that, okay, let's look at this example. Okay. See if we can figure out if these things should be investing, financing, or operating. Okay. The 3 sections. Okay. So issued 100,000 shares of common stock. Investing, financing, or operating? I'm issuing my own stock. Well, why do companies issue stock? To look at the money?
Financing.
They use it because they need financing, right? Okay, good. Okay, good. I borrowed 200,000. Why do you borrow money?
For cash, for investment,
To
operating.
expand, business expansion. Sorry to interrupt.
Let me ask you a question. When you borrow money, do you borrow the money because you have the money?
No,
Do you borrow the money to look at it?
No, I don't think so.
Financing.
You borrow money because you need the financing for something, right? I am gonna, like when you guys buy your first million, you know, when you buy a house for $2 million, you're gonna say, well, I don't quite have 2 million. So what am I gonna do? I better borrow some money, right? To finance the purchase of that house, right? So borrowing is a financing, right? Okay, good. How about if you purchase a truck?
Investing.
Good, you're making an investment. Excellent, right? I'm assuming you're a trucking company of some sort or a delivery company, whatever. You make an investment so you can make some money off of this. Good. How about if you pay employees?
Obviously, operating.
Good, that's operating. Good, that's your day-to-day operations. You got to pay your employees, right? How about if you collect some cash for services performed?
It's also operating.
Services performed, that's operating. Good, good, excellent. Okay. Okay, good. I think we have beat this about as much as we can. We've gotten as much as we can out of the slides right here. What I want to do right now, and then we're going to take a short break. I want to right now go ahead, okay, and I want to look at, keep it. Hang on a minute, guys, because I don't want to lose this. Save as. There you are. And I'm just going to call it markup. Okay, and then I'll go ahead and I'll post that so you have all that scribbling we did. Okay, and then what I want to do, now I can close it, is take a look at, okay, that's all right. What is this nonsense? Oh, I see now, I don't want that. And of course, every time they make you enter the passcode, because everybody knows that San Jose State keeps the secrets to the nuclear code inside of Canvas. So it's important that each time we make the person put in the code, because we don't want the Russians getting into San Jose State's Canvas and finding the secrets to the nuclear code, right? Okay, so I got to do that 10 times a day. So anyway, come over, and if you look at practice midterm final, you will now see some practice midterm twos. You should see those now. Okay, so I'm going to open up this practice midterm 2. And I'm going to go straight to the chapter 12 questions. I just want to go straight to these chapter 12 questions so you can see how those will look. So I'm not going to do the chapter 12 practice midterm, although you should do that, okay? But for the sake of time, I'm going to go straight to these chapter 12 ones. I said I'm going to go straight to the chapter 12 ones. Okay, here we go. Okay, so let's just go ahead and let's work these. Okay, and we're gonna work all the chapter 12 ones, then we're gonna take a break. Okay, then we're gonna go look at chapter 13 slides. We'll look at the chapter 13 questions in this practice midterm, and then we'll look at the rest of the questions in the practice midterm so that you have a full review of the practice midterms. And then I think you saw there were 2 other ones up there for you to practice with on your own as well. Okay, but let's just take a look. And this one is asking me cash provided by operating activities is what they want. So if I'm calculating cash provided by operating activities, I'm starting with what?
Income.
Good.
Net income.
Start with net income. Good. Did they give me net income?
Yeah.
Thank you, guys. 200,000. Okay, I think I'm gonna plus this out a little bit more. Good. Then they told me the depreciation expense. What am I supposed to do with depreciation expense?
Add.
Always add depreciation expense. Depreciation expense is 60,000 here. Good. How about dividends paid? And dividends paid goes where? Down in the financing section, right?
Yes.
Yes, so I need to ignore that. How about loss on the land?
Ignore.
No, loss on the sale of land clad. Current item,
Yeah, it's essay, so add.
losses and gains do the opposite. So I'm going to add the loss, right? I know it's kind of annoying because you're like, but John, you told me that if I acquire property, plant, and equipment, that's down in the investing section. And it is, the acquisition of it is. And if you sell it, the actual cash that came in is also going to be a cash provided by investing activity. But that gain or loss is an accounting number that has nothing to do with the actual cash on that transaction. So what they tell us to do is, in effect, reverse the effect on net income and then put the actual cash proceeds that came in down in the investing section. Okay, so I'm reversing the effect. The loss would have decreased net income, so I add it back to get a cash provided by operations number. How about decrease in account receivable?
So you do the opposite.
Good. Clad, it's a current item, accounts receivable. I do the opposite. So since it decreased, I'll do what?
Add.
Add the decrease in accounts receivable. That's how much? 30,000?
Yeah.
And then decrease in accounts payable, I do the same, don't I?
Yeah, subtract.
Did I say receivable? I mean payable. Do the same, it decreased, so I subtract it, right? And when I do all that, I should get the answer here,
260.
260, which, okay, guess this file doesn't highlight the answer, but they show you down here how to calculate it. Okay. Okay, good. Let's do another one. The following data are available. Net cash provided by investing activities. So if you sell some land, is that going to be cash that's provided by investment?
No.
No? So let me get this straight. You're going to go and you're going to buy some land, pay say 50,000 for it, and you're going to sell it 6 months later for 225,000. Are you going to go to the bar and tell everybody what a great investment you made?
I don't know.
Sure.
Well, Yeah, don't go to a bar and tell somebody, because they might beat you up on the way out and steal your money. Okay. But you did make a great investment, didn't you? If you bought land for 50,000 and then 2 months later you sell it for 225, that's good work if you can get it. That's a good investment, isn't it?
Sure. It's like over 200% in return.
Yeah. So if you sell land for 225,000, that's cash that came in from an investment, isn't it? You invested in land and then you sold the land and you got some cash for it.
Correct.
How about sale of equipment?
That's not an investment.
It's not.
It is.
You selling the equipment. I mean, there is no the market value drop.
Because when you purchase
Well,
it,
if I sell the equipment for 130,000, then that's what the market value was, right?
Oh, I see. Got it. Got it.
Okay. And so if I sell equipment for 130,000, that was the sale of investment, wasn't it?
Right.
Okay. One time my dad sent my brother, who's got some problems, let him buy a PlayStation or Playboy, not Playboy, Game Boy. Playboy is something else. Let him buy a Game Boy, I think, or a PlayStation. I don't know. I don't play video games, guys. The only video games I ever play are the ones that involve the shooting. I don't play these kind of video games. I need an actual fake gun when I'm shooting. I like those, but I don't like this kind of video game. Anyway, so he gets it and it costs $500. And then my sister talks to my brother about 2 months later and he says, "Oh, I sold it for $50. And I'm like, well, there's a shrewd businessman. He can turn $500 worth of equipment into $50 cash like no other. Okay. But if you sit there and you sell off a investment that you made before, whether you sell it for less or more, the cash provided is what you sold it for, right? Which is what we're trying to get here. Cash provided by investing activities. So my brother would have put down cash provided by investing activities of $50, even though the fool sold it 2 months later, but he didn't care because my dad's the one that gave the 500. Anyway, stop, John. Okay, so whatever you sell it for, it doesn't matter if you sell it for more or less than you paid for it, more or less than its book value, the proceeds that come in is cash provided by operations. Okay, how about issuance of common stock?
finance.
That's
Financing.
financing. Good. How about purchase of equipment?
Absolutely investing.
When you buy that equipment, whatever you paid for that equipment, that comes what? Out of the investing section. How about payment of a dividend?
Finance.
That's financing when I pay those dividends. Good. So you do the math on that one, and the answer is what, 285?
Yeah.
Okay. Okay, good. Let's try another one. Yeah, okay. We'll do this one and then we'll do 31. We'll do a couple more. I think we'll give you enough chance to get the hang of this. Okay, how about cash provided by financing activities? So how about increase in account payable? That's operating.
Operating.
How about increase in bond payable?
Financing.
Good, that's financing. You issue bonds to get money, don't you?
Yeah.
Huh?
Yes.
Right? You guys deal with this all the time. If this was a finance class, you'd be all over that. You'd be, yes, sir, professor. Bonds, bond and stock mixed. We use the capital asset pricing model for that. Okay, it's an investment. Okay. I mean, it's financing. Okay, good. How about sale of investment? That's clearly what? Investing. How about issue of common stock?
Financing.
That's financing, right? Good. Okay, and so we got some cash from bonds, got some cash from stock, and then we paid dividends.
Financing.
Good, you paid dividends on your stock, so that's going to be a subtract. So that should give me now what, 370?
Yeah.
I don't know. Look at, I didn't intend to put this down here. They say hard, difficulty hard. Why? This is not that bad. Okay, statement of cash flows is not that bad. Okay, you make it seem like more than it is. Okay, you have your balance sheet, you have your income statement, and then you just sit there and analyze those two to come up with the statement of cash flows. Okay, all right, good. Operating activity. If it's operating activity, we start with what?
Adding.
Good. Net income. Oops. Now this is what?
Oh, it's loss. Yeah.
This is a net loss. So I guess I better say net loss, right? Of 6,000. Loss is negative. And during the year, accounts receivable increased 15,000. What should I do? Accounts receivable is an asset. What should I do?
Subtract.
Do the opposite. Since it increased, I do the opposite. Merchandise inventory decreased. It's an asset, so I should do what?
Opposite.
Inventory is an asset. It decreased, so I do the opposite. I add it. Good. Accounts payable is a liability. It decreased, so I should do the same, shouldn't I?
Subtract.
Okay. Depreciation expense. What do I do with depreciation expense?
Yeah, always.
Always add. Clad can have two A's in it. Always add the depreciation. Anything else?
No.
Okay. Cash used was 17,000. Okay. You want to take a break or you want to do one more?
Do
One more.
Okay. See, now we're having fun. Okay. So net income is what? Always start with net income, 105,000. During the year, inventory decreased. If inventory decreased, I do what? It's an asset. Do the opposite. I add it, right? Accounts payable decreased. It's a liability, so I do the same, don't I? Depreciation expense, I always what?
Always add.
Always add depreciation. And then gain on disposal of equipment, 9,000. So I do the opposite for gains and losses. So since it was a gain, I have to what?
Subtract.
Subtract it. I do the math on that. I should get this 109.
Yes.
Okay, guys? All right, practice with those. If you're saying, John, you've got us memorizing, I explained the logic through that long example. You understand the examples, the year one, year two, year three, year four thing, and you see how that all worked itself out. Then all you do is you kind of commit to that mnemonic, CLAD, follow that, you're able to do every single one of these problems like a champ.
So I have a quick question.
Yeah.
What do you mean by gains and losses? Like the gain of a disposal of equipment, like you purchased it, or what's a gain?
A gain means that I sold the asset. And if I sold it for more than its book value, that's a gain. And if I sold it for less than its book value, that's a loss.
And that's not an investment.
Well, it is an investment, but I'm taking the gain and loss portion of that, and I'm showing that I'm backing that out, its effect on net income. And then I'm
Okay.
proceeds, and I'm putting that down in the investing and financing section. So I was trying to.
Hey, John, are you referring to capital gain, capital loss, short-term, long-term? Is that what it is?
This is not tax.
What's that?
Those issues that you just raised are tax issues.
Oh, okay, got it.
Okay.
Thank you.
So over here, we had equipment with a book value of 700, right?
Yes.
The equipment minus the accumulated depreciation gave it a book value of 7. And when we sold it for 500 cash, we sold it for less than its book value, didn't we?
Yes.
Okay, so when we prepare the income statement will show revenue of 0, expenses of 0, operating income of 0, and then in the non-operating section, remember we said in the statement of cash flows, the gains and losses on sale of equipment are always going to be non-operating.
Yes.
We'll show a loss on the sale of equipment of 500, right?
Okay.
Report net income. Net income will be a loss of 500, right? So what we'll do when we prepare the statement of cash flows, okay, we'll show net loss. Damn it. We'll show net loss, John, of what? 500. And then we'll add the loss of 500 to get cash provided by ops of 0, because we didn't have any cash provided by ops. Selling your equipment is not part of your day-to-day operations, right? When you go to Nordstrom, they don't say, would you like a cash register with those shoes, sir? But they could indeed sell their cash registers. And if they sell them for less than book value, that's a loss, right? It's an accounting loss. Then on the statement of cash flows, we would keep going. And in the investing section, so pretend like this is this statement of cash flows, and we keep going. And in the investing section, we would show cash from sale of equipment of what? 500. And then if there were no other transactions, financing was 0. The change in cash for the period would be what? Would be an increase of 500, and assuming this was the only transaction that happened this year, was this sale of this equipment right here. That's true. Cash did increase 500. Why did it increase? It increased because this company sold some equipment. So when you look at a statement of cash flows, and maybe I should have made this point earlier, when you look at a statement of cash flows, and I guess I should do it right here, where I just gave this example, do you want to invest in this company? Assume the numbers were bigger. Say it's 500 million. You saw net income of 500 million, and you're like, whoa, what a year. This company had, a net income, even though I showed it as a loss. This company had net income of 500 million. Let's say it was 500 million gain on the sale of equipment. They had net income of 500 million. But when you back out that gain, if it was a gain, you'd subtract it. Cash provided by operations is 0. And the cash increased 500 million, not because this company had this great revenue generating activity. It's because they sold off their equipment. So this may not be your company. You'd look at this thing and say, well, wait a minute. Yeah, the cash went up 500 million. Why? It went up 500 million because what? because they sold some equipment, not because they had all this cash being poured in by their day-to-day operations.
That makes sense. Thank you.
And that's why we set these things up this way. Okay, but again, for you guys, for the understanding how this whole thing was put together, it's what? It's CLAD for the operating. It's my financing department for my financing activity. It's my investing department for my investing activity. Okay. Question? Okay, guys, let's take a quick break and we will return and talk quickly about chapter 13 and then go through the balance of this practice midterm. Sound like a plan?
What time do you want to be back?
Yeah, that's a good question. Why don't we make it, let's just make it 8:35, okay? A little more than 10 minutes.
Thank you.
Okay. Okay, guys, I want to go ahead and jump us back in and go ahead and take a look at chapter, just scrolling down Canvas here. Now we're going to take a look at chapter 13. Okay, and chapter 13 is going to be very quick. Okay, we don't have to spend a lot of time with some of these basic financial statement analysis tools. Okay, so we're going to be looking at these various tools that are designed to help us understand some characteristics of the business, such as their liquidity, their profitability, their solvency. Okay, when we do our comparisons, we can do them within the company. When we do them within the company, that tends to be horizontal or vertical analysis, and we'll talk about each of those. When we compare the company to industry averages or we compare company to company, that's where we tend to get more into a ratio analysis. And again, these different analysis can help us with these characteristics of liquidity, profitability, and solvency. Okay. So you take a look here and we start out talking about horizontal analysis. And we say that horizontal analysis is a trend analysis, or it could be called, I've seen it called longitudinal analysis. And so if we're looking at a trend and we're trying to look at what's happened between 2020 in 2019, right, we would compare different line items on the financial statements across the years. Thus the term, and I'm not trying to insult anyone's intelligence here, horizontal analysis as we go across from year to year, say on a comparative set of financial statements. Okay, so just to take a look at this, and guys, sometimes I think it helps if you go ahead and bust out your calculator to figure out how we're going to do this horizontal analysis, which is going to figure out the percentage change. Okay, so in this example, okay, we're going to go ahead and we're going to take a look at 2009 versus 2008. Now, when you look at 2009, we see that they had 1,020,000. And for their current assets, let's say just using that first line item as we go horizontally, And then we're going to subtract from that this 945,000. As you can see, and they calculated it for me here, that's a change of 75,000. Now to get the percentage change, I divide that $75,000 change by the first year in the analysis. So the first year in this analysis was 2008. So I go ahead and divide 75,000 by 945,000. And when I do, I get this 7.9%. Okay, so horizontal analysis, longitudinal analysis, a trend analysis that goes over years does what? Calculates the change between the years of the analysis, and then you divide that by the base year. The base year is the first year in the analysis, and that's how you would calculate a percentage change, which is an example of a horizontal analysis. Okay. Okay, good. Vertical analysis is going to go vertically. It's going to select a base, frequent basis, sales, and it's going to calculate different, say, income statement items as a percent of sales. Or you could take your balance sheet and use as your base your total assets and calculate your different line items on the balance sheet as a percent of that base, say, total assets. Okay, so you come down and you take a look, and if we were using total assets as our base and we wanted to know what percent of those were current, we would take what? We would take the current assets of, and I'm assuming we're going to go ahead and use 2009 in this analysis, and we would divide the 1,020,000 by the 1,835,000. That would give us the 55.6. You would take the 800 and you divide it by the 1,835,000. That gives us the 43.6. Okay, vertical analysis. You could do that with your sales as well. It doesn't have to be the balance sheet. You could use the income statement for these kinds of analysis. Okay. Ratio analysis could be liquidity, could be profitability, could be solvency. Guys, we could go on and on with different ratios. I'm going to limit it to a few basic ones just so you're aware of some of the basic ones. And if this was a financial statement analysis class, they would probably beat you up with ratios forever, okay? But just to look at a couple, okay? Liquidity ratio. And we've sort of already talked about this a little bit, but to get our current ratio, we'll divide our current assets by current liabilities. Now, we want this number to be greater than 1. You never want this answer to be not this answer, but this ratio to be less than 1. If the ratio is less than 1, that means that our current liabilities are bigger than our current assets. This company has a what? Has a liquidity problem. They don't have enough assets to cover their liabilities that are currently coming due. A company that has the numerator smaller than the denominator, that has a less than 1 current ratio. This one on the screen, this Quality Department Store, is, I think, probably doing okay. And if they have what? About a 3-to-1 current ratio. 3-to-1 might be good, 4-to-1 might be good, maybe 5-to-1. You got to be careful. A current ratio that gets too big, say 50-to-1, well, why would you invest in that stock? That company's got plenty of cash that apparently they can't figure out what to do with it. They're hoarding cash. Okay, so, you know, it varies by industry, but you would expect that, you know, a 3-to-1 is pretty good. And then again, notice they go ahead and they might compare that to other companies in doing an intercompany analysis. And so here they got an industry average. Here they're comparing themselves to JC. Is JC Penney still in business? I don't know. I don't think so. Okay.
Yeah, their ratio is probably not so good anymore.
Yeah, I'm thinking JC Penney, they're gone, right? Okay, I need to change this slide. Okay, we're not going to worry about accounts receivable turnover. Don't worry about it. We didn't spend a lot of time dealing with accounts receivable and net account receivable and whatnot, net credit sales. We talked about net credit sales, but not net receivable. Don't worry about receivable turnover. Okay. So we'll get past that. Okay. Let's look at inventory turnover. Okay. Now, what happens? For inventory turnover, you're basically going to take the cost of goods sold and divide that by your average inventory. And that will tell you how many times you sold out of inventory over the course of the year. Now, it doesn't mean that the company went down to zero 2.3 times. It's just an average of how frequently you were able to sell through your entire inventory. Now, sometimes students say, well, why do you take the beginning inventory plus the ending and divide by 2? Because I want an average of 2 numbers. And if I want an average of 2 numbers, I divide it by 2. And you say, well, then why do you take the beginning and ending? Because nobody dies if I don't give a beautiful, perfect inventory turnover number. If I was building a bridge and I was trying to figure out the average wind velocity throughout the year so that the bridge won't be blown down, okay, I would be a fool if I took the wind velocity on January 1st and then took the wind velocity December 31st and said, okay, there's the average. That's ridiculous, okay? That is not a good analysis. That bridge is gonna blow down. If we're just talking about a financial statement analysis where we're trying to get a rough idea of how frequently this company turns over its inventory, then taking the beginning inventory plus the ending 2 numbers, adding them together, and I want the average of those 2 numbers, gives me the average balance, a rough estimate of my average balance of my inventory. I divide that into my cost of goods sold. That essentially tells me how many times I sold out of that inventory. Rough analysis. This company sold through their inventory 2.3 times. Now, the inventory turnover in and of itself is not as informative as it is if you take the number of days in a year, divide that by the number of times you turn the inventory over, and that tells you how long items sat in my inventory before I was able to sell them. And this says 159 days. Well, I don't know. If this is real estate, okay, maybe not too bad. Depends on what's going on with the market, depends on the industry. If this is a sushi restaurant, don't eat there. This is a problem. If it takes you 159 days to turn over your inventory, this should be more like, what, 2 days, right, for a sushi restaurant. So it depends on the industry, okay? Some people might say, well, 159 days in this market is horrible, okay, because maybe inventory is moving quicker if it's real estate or something. I don't know. It depends on the industry. Okay. Okay, good. Solvency ratio, and the easiest ratio in the world, and I think we talked about this back in chapter 2 or so, maybe chapter 3, I don't know, I forget now, is the debt to equity ratio. It's the easiest thing in the world. Debt, okay, in the, I should say debt to assets. Debt in the numerator, assets in the denominator. Debt to equity we talked about before. Debt in the numerator, equity in the denominator. Debt to assets, debt to equity. Question. I told you this was quick. Okay, so what I want to do, if there are no questions about that,
Those were just 3 ratios, right? The numbering was confusing.
You had the ones we talked about, current, I said not accounts receivable turnover. So you had current ratio, you had inventory turnover, which we then turned into days in inventory by dividing that by 365, or dividing that into 365. So I'll count that as a separate one. And then we had debt to assets. 4, if you want to count days in inventory as a separate.
Okay, thanks. Yeah, just the 12s. I just wasn't sure if I like blinked and then passed out, and then all of a sudden we're on 12.
I cut out a lot of them because, I could sit here and give you a 50, page exam on ratios. And at the end, who cares? You want to figure out a ratio, look it up and figure it out. It just, to me, this is not the place to make you do a bunch of ratio analysis. But I don't want to just completely ignore the fact that our textbook has a chapter 13 that does talk about ratio analysis. And Danny will talk a little bit about some analysis of financial statements. To me, the most important ratio we've talked about is the gross profit percentage, which is it's our gross profit divided by our net sales. And Danny will probably talk a little bit about that particular ratio. Does come up more in analysis than some of these others. Okay, so no, you didn't pass out. I don't think. But let's go ahead and let's take a look. And what I'm going to do now is go back through that practice midterm. But this time, I'm going to look at it. Looking for those chapter 13 type questions. And then we'll come through and we'll look at questions that I'm passing by right now that are relevant to chapters 4, 8, and 11. Okay, but let's just go ahead and let's take a look. And they want the percentage increase in sales between 13 and 14. Okay, so what am I going to do? I'm going to take this 800,000, the sales in 14. Okay. And they didn't call it out as horizontal analysis here, but that's what it is. And then I'm going to look at what it was in 13 of what, 650? And we get a $250,000 difference. We divide that by, oops, what are you doing, John? We divide that by what? The first year in the analysis. 650,000. And I should get that number. Okay. Okay, 2013 to 2016. Now, the percentage change doesn't have to go calculated between consecutive years. Okay, so in this example, they want me to calculate the percentage change in sales from 2016 to 13. And that gives me a difference of what? 1,050,000 versus 6. What's that?
$350. No,
I got 400,000. No.
400. Yeah.
Okay, so that's $400,000 difference. I divide that by what? Always by the first year in the analysis. I don't care if it goes over 1 year or several years here like this one does. You still use the first year in the analysis. That gives me a 61.5% increase. Okay.
Hey, John, just real quick on, was it question 15 or 16? I got a different number. I got 38%, 38.5.
What did I do? Make a mistake in my calculation here?
Well,
8,000
100 not 257.
minus 650,000 is 2013, right? 150.
Yeah, that should be
oh
150.
yeah, there it is.
I should never do anything without my
Got
calculator.
it.
It's
Okay, yeah,
6,000. No, thank you. It's 23.1. So
Yeah.
the numbers, right? I did this wrong. Thank you. That's why I don't do anything without my calculator. I constantly make mistakes like that. Okay, which of the following would be a use of the statement of cash flows? Return on investment, reason for the difference between net income and cash provided by operations, or cash lost because of poor controls, right? We spent quite a bit of time calculating or understanding how we start with net income and end up with cash provided by operating activities. And we saw if we had change in my current items, depreciation, etc., right? So the answer is this middle one here. Okay, assume the following data for a company. You getting tired? Okay. Same thing. Come on now. Let's see. 2015 is 950,000. 2014 is 800,000. Is that $150,000 difference, guys?
Yes.
Okay, good. And I divide that by what? The first year in the analysis? 800,000 gives me 18.8. Okay. I'm not going to do any more of these. I'm getting bored. Let's use this one now. Okay, we'll do one more. Use vertical analysis. Use vertical analysis. What is the percentage that is assigned to cost of goods sold? So I'm going to take what? Vertical analysis, and I'm using a base. Now, yeah, I would have had to told you that I want you to use net sales as your base here. So I'm not going to expect you to just pull out of where what the base is that we're using, because you could use different bases. I mean, I could sit here and calculate net income as a percentage of cost of goods sold or something. I mean, there's no rule that says you always use net sales in this sort of a vertical analysis. So I would tell you what I want you to use as the base, okay? But this problem wanted you to use net sales as the base. And once you know that, that's a piece of cake. What you needed to know is what? How do you do vertical analysis? You pick a base and then you divide that by one of the line items that constitute the total of that base. Okay. Here, they gave you the same information, and now they wanted net income. Okay, again, I would tell you, I want to know what net income is as a percentage of sales. And so the net sales was 300, net income was 75. So I guess that gives me C as the answer. Okay, I'm not going to ask you accounts receivable turnover. Okay, I may ask you inventory turnover. Okay, so let's just take a look at that. Okay, and so we've got a company that had cost of goods sold of 15 million. Now this problem just told me the average inventory. So I didn't have to sit there and calculate the average inventory by taking the beginning plus the end and dividing by 2. And when I take 15 million and I divide it by 2,500,000, this company turned their inventory over what, 6 times? And then to get the days in inventory, how many days in a year? 365. I take the 365 and I divide that by what? By the 6 times. This company turned their inventory over 60.83 times. The world's easiest ratio is current assets divided by current liabilities. The current ratio, I don't know, maybe debt to equity is easier. Debt divided by equity, debt to assets, debt divided by assets. The current ratio is right up there in the category of easy ratios. Current asset in the numerator, current liability in the denominator. So it's 2.5 to 1. Okay. Now, guys, be careful. I know this stuff is easy. And what I see with my students sometimes is they see this stuff and then your brain says, okay, John's going to give me 30 questions on chapter 13. No, I'm giving you 1, 2 questions like this, maybe 3 questions or something, because I know how easy they are. Okay, so yeah, spend some time looking at this, but don't go in with your strategies. I'm going to get all chapter 13 questions right, and because I understand this stuff, and that's going to get me an A on the exam. No, it's not. Okay, the exam is going to be heavy towards chapter 4, 8, 11, 12, with a couple of questions related to chapter 13. So what do I got? 4, 8, 11, and 12. What's that? 4 chapters? 4, 8, 11, 12. Okay, so 4. So if I have 30 questions and I give you 2 from chapter 13, that leaves me 28. 28 divided by 4, it's going to be like 7 questions from chapter 4, 7 questions from chapter 8, 7 questions from chapter 11, 7 questions from chapter 12. And that's for my classes that are only having those chapters on the final. If I'm having a class that this recording is going to be used for another class, it won't be that same thing. Okay. But for this class that I'm speaking to right now, that's how it's going to go. So with that, let's go all the way up to the beginning of this practice midterm. And let's see what we get here. Okay. So you take a look and we have income from operations. And let's just review the multiple step income statement for a minute. We have sales. Less what? Returns less cash discounts. What's that going to give us? We're into midterm review time now, guys. What's that going to give us?
Net sales.
Excellent. Net sales. Good. Then we will subtract what? What's COGS?
Cost of goods sold.
Cost of goods sold. That's going to give us gross profit. And then we're going to bring in our operating expenses. Those are day-to-day expenses, right? Salaries, that kind of stuff. And that's going to give us operating income or loss. And then we'll have what? Non-operating section. And non-operating is going to be interest, revenue, and expense. And what? Gains and losses. Whatever those are. And then we'll have what? Net income, right? Okay. So you got to know this multiple step income statement. You're going to get a bunch of questions like what you see here. So income from operations is gross profit less what? Operating income, income from operations are synonymous. So it's gross profit less operating expenses. Sales minus cost of goods sold is called what? Gross profit. After gross profit is calculated, operating expenses are deducted to determine, well, okay. You look at these choices and you say, well, the answer should be operating income, but they don't give me operating income as a choice. But let me ask you, does a company have to have interest, revenue, expense, gains and losses on sale of equipment? Do these things have to happen? Does every company have to have interest, revenue, expense, and gains and losses on sale of equipment?
Yeah.
No.
In fact, that's the whole point of showing them a separate section, is that they can come and go, right? So they're not day-to-day operations items. So if a company doesn't have these, then what? You take gross profit minus operating expenses. There's no sense in stopping at operating income because you don't have any non-operating items. So you would just go straight to what? Straight to net income here, the answer to this question. So this one you'd have to answer by process of elimination. It's not what? It's not gross margin. It's not gross profit, which all of the A, C, and D are synonymous terms. Gross margin, gross profit, net margin are all the same thing. Okay, let's take a look at this one. And we've got this company that had this merchandise, and they had recently purchased 200 CDs, an invoice of 6,000, and the terms were 210 net 30. Okay, half the discs were incorrectly labeled and were returned immediately to the supplier. The discount period has expired. The journal entry to record the payment. Okay, now guys, as I've stated before, questions like this are designed to throw you out of your training, to get you to do something that you have different than what we've trained. You practice and practice making journal entries, debits and credits, and then this question's trick is that it sits there and says, well, don't worry about what you learned. Don't worry about it. Just give me the debit or the credit, and fakes you into making a mistake. Okay, so your best way to answer this question is to follow your training. Say, when I want to record a transaction, I make the full journal entry. Okay, so when we first purchased the CDs, I'm going to debit what? There was a cost of 6,000. I'm purchasing these items.
What?
What am I going to debit? Journal entries have debits and credits. I just purchased inventory.
Debit inventory.
Debit.
Okay, good. I debit inventory for 6,000. And I'm going to credit account payable. Now, how do I know that I should credit account payable and not cash?
It's a perpetual inventory system.
No, perpetual inventory system meant that I had to debit inventory, not purchases. Okay, so when you purchase inventory in this class, you'll always debit inventory on a perpetual system. How did I know that this wasn't a cash purchase?
Invoice.
It's an invoice price.
Terms to
Oh,
this.
terms.
Yeah, I did terms.
Good.
Darn
Excellent. They gave me the terms 210 net 30, right? Which means I get a what?
Just
2% discount if I pay in 10 days. Otherwise, I have to pay the whole amount in 30.
38.
Right? Okay. Now, they tell me though that I returned half the CDs immediately. So what am I going to do if I return half of them?
Credit.
you return half. They're incorrectly labeled.
Well, if you return something, do you have it anymore?
No.
So if I don't have these in inventory anymore, what should I do?
Credit.
Credit inventory.
Good. I'm going to credit the inventory for 3,000. Good. And if you return something, do you owe the person the money anymore?
No.
No. So I'm going to debit account payable, right? For 3,000. So if you were to tee these up, account payable now still got what, 3,000? And inventory still has got 3,000? Right?
Yeah.
Okay.
Okay. I didn't post the whole thing, but that's what we got now. Okay. And then they tell me the discount period expired when I pay the man. So when I pay them, I'm going to have to do what? How much does the guy want?
He's gonna want the full amount.
He wants the full amount. So I'm going to have to pay him cash of how much?
3,000.
When you pay cash, you credit cash 3,000 and I debit what?
Well, 3,000.
The account payable 3,000 because I'm paying them now.
Yep.
Right?
Yes.
Okay, good. So when you look at this, guys, the way you answer a stupid question like this is they say we get cool with the answer, credit cash for 3,000, right? Okay, but I'm telling you, if you don't do it this way, say, John, I don't have to do all that. And then you get on a question, and I promise you the question it'll punch you in the mouth if you don't do it properly. If you don't sit there and go through your training, you're gonna get baited in to selecting the wrong one. Okay. Okay, good. Glenn Company purchasing merchandise inventory with an invoice price of 7,000, terms 210 net 30. What is the net cost of the goods if Glenn pays within the discount period? So what's going to be in my inventory account as a result of this, right? So if it's a $7,000 invoice price and the terms were what?
To 1030.
10 net 30, that means I got a
2% discount within 10
2%
days.
discount.
Discount.
Okay, I paid within the discount period. So what's that? $140. So 7,000 minus 40 should give me this 6860.
Yes.
Okay. All right, Jake's Market. And we had a similar problem to this in chapter 4. And I told you that when you have a question like this, which gives you a whole bunch of facts, unfortunately, the fastest way to answer this is the long way. I'm going to give you 3 hours to work this exam. Don't be in a rush. Set yourself aside the full 3-hour time window and thoroughly go through a question like this and make all of the entries. And then you'll be in good shape. Okay? So what happens? They tell me that I received inventory of 50,000 terms 210 net 30. Who wants to give me the journal entry for this first thing?
Debit inventory 50,000.
Good. Debit inventory 50,000. Great. What do you want to credit?
Account payable.
Payable.
Good. Accounts payable got to be credited for 50,000 because I am giving credit terms here, right? So I'm just going to go ahead and tee these guys up. I think it looks prettier if I tee them up down here, I think. Inventory. I just debited for 50,000. Account payable. Just posting those, right? Okay, good. Then they tell me that we return 1,000 of the shipment for credit. So if that's the case, I'm going to do what? I'm going to, if I return the inventory, I'm not keeping it. So I'm going to credit inventory for, what is it, 1,000? And if you return something, do you still have to pay for it?
No.
So
I debit the account payable. So now account payable got a balance of 49. And so does the inventory, right? After I post that. With me so far? Okay. Now I pay $250. So I'm buying the inventory and I pay the freight. That's freight in. Now I'm going to credit cash because you pay delivery people in cash, don't you? Okay, just think of an Uber ride. You don't tell the guy, hey, see me next week and I'll give you the guy's going to say, oh, give me the money. What are you talking about? Cab driver. Go ahead. Try and tell a cab driver at some point in time you're not going to pay him after the end of the ride. See what happens to you. Okay, so you go ahead and you credit cash, 250. What do you want to debit?
inventory.
Good. Freight in, very good. Freight in, I debit the inventory, don't I? For the freight in, any money that it cost you to get an asset to your business so you can use it in your business is added to that asset account, right? So now I've got 49,250. Now, if I pay the invoice in the discount period, how much is the invoice right now? The guy still wants 49,000 from me, doesn't he?
Yeah.
So if it's 49,000 and I pay within the discount period 2%, 49,000 times 2% is going to give me $980 discount,
Yep.
right?
Yep. 980.
Huh?
Yes. 980.
980, good. So if he wants 49,000, or he wanted 49,000, but he agreed to give me a $980 discount, that means that I'm actually going to only have to send this dude what? 48,020?
Yep.
020?
Yep.
Okay. So when I pay the guy, and I'm going to go ahead and co-op some of this space down here. I'm going to credit the cash for 48,020. I'm going to debit the account payable for the full 49,000. And then I have to, do I need a debit or credit to make this journal entry balance?
Credit.
I need a credit of 980, don't I? And that credit of 980 will go to what?
Inventory.
Beautiful. It goes to inventory because I'm not paying that full 49. I'm paying what? 4820. Good. So when I credit the inventory for that 980, just posting that 980 right there, now this balance comes down to what? 49,250 minus now 980 gives me a balance of 48,270.
Yep. 270.
Which is the answer to this question.
Let's see.
Okay. Now, when you look at it, how much cash should I pay for the inventory? 48,020 plus what? Plus this 250
Uh-huh.
is the total cash I paid out for this inventory. Isn't this beautiful? Have you ever seen anything so beautiful in your life? The inventory count shows what I paid for it. And it should. Okay. Again, the trick to a question like this, guys, is go through methodically, follow your training, do what we taught you in chapters 2 and 3. Follow what the transaction says, debit, credit, balances, and that's how you get the answer to a question like this. And you'll have plenty of time to work through something like this. Okay. Now here we've got what? The collection of cash within a discount period. Okay. So apparently what happened here was we had accounts receivable of what? 4,000. And we had a credit to sales of 4,000. With me so far?
Yes.
And then when we paid or received money in the discount period, well, now our customer is not going to give us the full 4,000. They're going to give me what? 4,000 times 2 is going to be $800. Am I doing this right?
It'll be $80.
Thank you. $80. So that means they're going to give me 3,920.
Yep.
Okay. So when they pay me, I don't know where that came from. I don't know what the hell that is. I have no idea, guys. What it is, it's like an alien invader. You got me. Your guess is as good as mine. Microsoft is losing their mind these days. Okay, and so what happens? Let's see if I can reverse it to get rid of it. Ho, 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 ho.
Wow.
Isn't that the symbol of Jesus? Okay, never mind.
You just
Okay, so 39
put
what?
a marker on a drywall board. That's what it reminds me of.
It's very weird. Anyway, we'll just live with it, guys. 3920, okay, is the amount of cash my customer is going to pay me, right? So what am I going to do? I'm going to go ahead and debit cash 3920. I'm going to go ahead and do what? Credit the entire account receivable 4,000 because I'm not expecting any more money from this guy. And I'm going to debit what? Don't say inventory. I'm going to debit discount. The person that takes that discount to inventory is the purchaser, right? This is the seller. the seller will have a discount. So when I prepare my income statement, I'll have sales, 4,000, minus what? Minus the discount of 80, and I'll show net sales of the 3980. How much cash should I get? I mean, not 3980, but 3920. How much cash should I get? 3920. My income statement shows net sales of 3920. Sales minus discount. Now, again, when Danny does his presentation next week, you'll see, you know, this, you'll see this, sometimes a company will just start with net sales. Okay, so let's go back now. Collection of 4,000 with a 2% discount will result in, and again, you're best off making the full set of journal entries, but we are going to end up with a debit to sales discount of 80. Yeah. Debit to account receivable. No, it's a credit to account receivable, and it's a credit to account receivable for the full 4,000. Credit to cash. This is C now. No, it's a debit to cash. Credit to account receivable of 3980. No, the credit is what? 4,000. Do you see how easy this question is when you make the full journal entry? You don't make the full journal entry. This is like driving with your eyes closed. I mean, you know, huh? You know, they tell you to keep your eyes on the road. Trying to answer this question like trying to drive a car by keeping your eyes on the pedals. Okay. Okay, good. Let's take a look at this one. Arquette Companies is presented below. What is the net sales? Now, this question is kind of weird, okay? They give me 470,000 of the sales. What do I have to subtract to get the net sales?
Returns, allowance.
Good. I'm going to take the returns of 20,000. That gives me the net sales 450, doesn't it? Now, what I don't like about this question is they made it too easy. You didn't even have to look at the other column. They should have had at least one other 450 in the net sales column, okay? But you automatically know the answer is A, but then to get gross profit, you would have to do what, assuming this problem was a little more challenging. You'd have the 450. What would you have to subtract to get the cost of goods sold? To get the gross profit.
Yeah. So cogs. Yeah.
Subtract the cost of goods sold. Freudian slip there, right? That's when your parents tell you, don't say anything about Mr. Lord's nose. Don't say anything about Mr. Lord's nose. And then you say, nice to meet you, Mr. Nose. I mean, Mr. Lord. Okay. 180,000, right? Okay, good. Now, this question asks the gross profit percentage. And gross profit percentage is going to be gross profit divided by what? Net sales. So we got some figuring to do here, don't we? Okay, so we're going to take our sales, 2 million. And then we're going to take our returns of 360. What else? Got to get off our discounts of 40. Anybody got a number there for me? 2 million minus 360 minus 40 is what for my net sales? $1,600,000. Is that
Yeah.
right?
Yep, 1,600,000 is right.
Okay, good. So I got my net sales, my 1,600,000. I got my denominator, but I got to get my numerator. And my numerator is going to be my net sales of 1,600,000 less what?
Cost of goods.
My cost of goods sold. My cost of goods sold, they tell me, is 1,120,000. So I take my cost of goods sold off of my net sales and I get,
480.
huh?
480.
Thank you, 480,000. Good. And so net sales of 1.6 divided into my gross profit, right? That's my gross profit. 480 gives me this 30%, I hope. Yeah,
Yep, 30%.
good. Okay, good. That's chapter 4. Let's go ahead and let's look at some chapter 8s. Okay. So this one wants to use double declining balance method. Important thing about double declining balance right out of the gate, don't use salvage value in the calculation. You do not use salvage value in the calculation. Okay. So they buy this asset for 100,000. And they tell us that the asset has a 5-year life. 1 divided by 5 equals 20%. Double that is what?
40.
All right. Now they want to know the book value of the asset at the end of year 2. Now this is where this question gets tricky. It's not really tricky, but this is how I make it worthy of your exam. For year 1, I'm going to take that 100,000. I'm going to multiply it by the 0.4, the 40%, and that's going to give me depreciation of what? 40,000, assuming it was a full year of depreciation. But I didn't put that asset into use until what? Until October. So I only use that asset in year 1 for October, November, December, 3 months. So I got to take that 40,000 and divide it by, or multiply it, whatever, by 3/12. So when I do that, I get what, 10,000 for the first year?
Yeah.
Okay. So for the first year, the depreciation is 10,000. So I'm going to subtract that off of my year 1 balance. And for year 2, I'm going to start with 90,000. I'm going to multiply that by what? Ignoring this stupid thing here. By 0.4, that gives me, and now I can take the full year depreciation, right?
Yeah.
So that gives me 36,000 for year 2.
Yes.
So I subtract that off of the beginning balance for year 2, and the ending balance for year 2 becomes this 54,000.
Yes.
The answer to this question? Okay. Okay, good. So the big takeaway there, guys, and they kind of gave you the same calculation. I just did it with you down this table. But the big issue there is be careful with that first year. Watch these depreciation problems. The way I'm going to harm you, the way I'm going to try to hurt you on these depreciation questions is by putting the asset into use after the start of the year. Take a partial depreciation. And I don't mean, if the problem says they put the asset into use January 2nd or 3rd or something like that, don't freak out, okay? It's going to be, you know, they don't put it into operation until April or something stupid like that. Then you got to take a partial year depreciation, and counting on your fingers is the most effective way of making sure you counted your months properly. Okay. Okay, good. Now we have an asset here that cost 87,000 and it's got accumulated depreciation of 40. The company sells the equipment for cash. What should we record? Okay, well, let's just go ahead and take a look at that. We've got equipment of 87. That's what we paid for it. It's got accumulated depreciation of, what is it, 40,000?
Oh, it disappeared.
What disappeared?
The little squiggly line.
Oh, huh.
Arbitrarily just now, it just went poof.
I'm telling you, it reminded me, isn't that what they used to say, that, religious characters would appear and then disappear? Okay.
Ah,
So that gives me how much? Never mind. This gives me
I remember the tree.
all kinds of weird things going on.
Yeah,
I mean,
I lived by a tree where
Uh,
there was I lived by a tree where there was a thing that people could see, and man, crowds and crowds of people came for a couple of years looking at it. And so I had friends that would go out and sell sandwiches and stuff in the line because people were seeing things.
Well, I have a tree in my backyard that's pretty nice. So I'm going to try that. Try to sell sandwiches through the fence here. So we have what? We have book value of what? 47,000. Okay. Now they sell it for what? Cash of 42. So if you have something that you think is worth what? 47,000 and you sell it for 42, do you feel like a winner or a loser?
Loser.
You think this thing's worth 47, you were only able to sell it for what? 42. So you have a loss here of 5,000, don't you? Okay. Now let's just do the journal entry for this though. If I'm getting rid of the equipment, do I want the equipment on my books anymore?
No.
No, I got to take it off. So I credit the equipment for 87,000. If I get rid of the equipment, I have to get rid of the accumulated depreciation. Accumulated depreciation is a contra asset. It's a credit. So I would debit accumulated depreciation to get rid of that. The cash is easy. The cash comes in at what? At 42,000. And I need what? I still need a $5,000 debit to make this journal entry balance. That debit is to what? Loss of 5,000. That debit will show up where? Will show up in the non-operating section of my income statement. And if this was a statement of cash flows, I'd do what? I'd add that loss back to my net income number to get cash provided by operations. And then I would show the actual cash proceeds here of 42,000 in the investing section, right? I mean, you didn't have to know all that to answer this question, but that is how it would affect the statement of cash flows. Okay. Relevant factors in computing depreciation do not include depreciation method. Yeah. If it's straight line versus declining balance, we're going to get a different result, right? Salvage value. Yeah. I have to take the what? Have to take the cost minus the salvage value. That gives me my depreciable base if I'm using straight line, if I'm using units of activity. I don't use the salvage value in the calculation under declining balance, but I do not depreciate below my salvage value. So I would still be considering it. Useful life would be relevant if I'm using the straight line method. The cost is important because cost minus salvage value. Market value is of no consequence when it comes to depreciation calculation. We already had this question, didn't we? This is a repeat. I don't want to do it again. We did that one already. Okay, let's look at this one. A company purchases a weaving machine for $190,000. The machine has a useful life of 8 years. Residual value of $10,000. It is estimated that the machine could produce 75,000 bolts of woven fabric. Okay. In the first year, 15,000 bolts were produced. In the second year, production increased to 19,000 bolts. Using the units of production method, what is the amount of depreciation that should be recorded for the second year? Okay, well, great. So I do what? And I'm just going to go straight to the calculation here, guys, because it's right here in front of me. I can't resist. 190,000 is what they paid. Subtract the salvage value. Divide that by the number of units. It's the total number of units they think they can get out of this thing, these bolts, whatever. So that's what? That's $2.40 per unit. And since they asked me the second year and they told me that they produced 19,000 units in the second year, I have to multiply that by 19,000. Depreciation is 45.6 in that first year. Okay. Okay, good. Chapter 11 questions. Hydro Slide issued 2,000 shares of $1 Power Vari common stock at $5 per par. As a result, what should happen to their liabilities? Nothing. Let's make the journal entry here. We issued 2,000 shares for $5 per share. So how much cash did we get? 10,000?
Yeah.
The par value was $1, so we credit the common stock at par, 2,000, and then we credit what? APIC for 8,000, which is the $4 per share times the 2,000. Okay. Now, if after that, so there's no liabilities here. After that entry, cash, assume that was the only entry they made. Maybe this is their very first entry. Yeah, I'm stuck with these. So my cash is 10,000. My liabilities are what? 0. My stockholders' equity is common stock of how much? 2,000? And APIC of 8,000. So my total stockholders' equity is 10,000, isn't it? Hello?
Yes.
That's my stockholders' equity. So now let's look at how this question gave you, this easy question gave you lots of points here. Okay? Because you're going to be able to answer a series of questions from it. So let's just take a look. Okay? Liabilities are 0. My asset is cash and asset.
Yes.
My cash asset came up 10,000. My stockholders' equity, common stock is part of my stockholders' equity, as is APIC, came up what? Well, we didn't ask stockholders' equity. If it did, the answer would be 10,000, but it didn't ask that. So this only answered these two questions. This question 13, I guess it was question 13A and 13B. There were two things that this fact pattern from 13 answered. Okay. Okay, good. Let's take a look at this one. And as a result, what would happen to my stockholders' equity? Now, different set of facts now, but they issued what? They issued 2,000 shares of $5 stated value, no par. So it was no par, but it had what? Stated value, didn't it? And they issued that for $8. So even though it's no par, the stated value replaces the par value. So I'm going to take the 8 times the 2,000 shares My cash is going to be 16,000. I'm going to credit the common stock using the stated value. So my common stock is going to be credited for what? 10,000. And then what? 5 minus 8 minus 5 is 3. 3 times 2,000 means that my APIC is going to go up 6,000. Okay, that's 6,000. I guess I gotta write that strategically here. 6,000. So I can use that 0 that's there. That's the credit to my APIC. Okay, so is it true that my stockholders' equity went up 16,000?
Yes.
Is it true that my assets increased 16,000?
Yes.
Good. Which of the following would be a use for the statement of cash flows? The condition of an entity's fixed assets? Come on. Return on investment? No. Cash loss due to poor internal controls. Look, public companies do have to report on the effectiveness of their internal controls, okay? But nobody in the world could tell you how much cash was lost because of the internal control. That cause and effect is impossible to calculate. That would be ridiculous. The only person that could tell you that is the person that actually stole the money. Well, look, they had this lousy internal control, you see. And you see, what I used to do when nobody was looking is I used to put the money in my sack and I used to walk out the door and nobody knew what was going on. And that's how I stole $10 million, okay? No one can tell you for sure how much money got lost by a poor internal control except the guy who stole the money, okay? So that's nonsense, okay? So then you come down to the company's ability to pay dividend. The correct answer here, yeah, absolutely. That was right off that slide. If I see a company whose cash position is shrinking year after year and they're using up a bunch of money they're not generating any cash from operating activity, I'm like, well, they'll never be able to pay me a dividend because they're not building up that retained earnings, cash and retained earnings by operating activity. So I'm not expecting a dividend. Or if I see all kinds of cash year over year, I do a longitudinal analysis now of the cash provided by operations year over year. Yeah, building up some cash from your operating activity. I feel a dividend. I smell a dividend coming. Okay. Okay, good. And I think we did all this. Okay, guys. Yeah, we're getting there. Any questions about the exam, etc.?
It'll look a lot like this that we're looking at right now, right? It'll just be
Yes, except don't expect this many chapter 13 questions. Yeah. So it'll be more heavily skewed to 4, 8, 11, 12. I just not in love with chapter 13 as a that want to spend a lot of time testing you on. It's too easy.
Okay.
Okay.
And this
So
this lecture tonight will be posted on Canvas.
Yeah. Yeah, I'll post it. Oh, I'm glad you asked that. I guess I ran out of room on Canvas. They only give you so much room to post videos. And I'm like, well, that's kind of how we're doing business these days. Why is there a limit? But I had to go back to my old method, which was I post the video to YouTube first, and then I just get the link and post the link in Canvas. And so when you click on that link, it'll say click here to see the video. And that will take you out to YouTube so you can see the video there, as opposed to watching it inside of Canvas, because they're not letting me, they limit how much room I have, how many bytes space I have to put things on Canvas. But the reason it's important that I mention that is sometimes I worry that, you know, students will click on my thing in YouTube and they'll see an offensive video of a dancing bear. And they'll go, oh my God, how could Professor Lord send us to see this dancing bear? That's you. That's YouTube saying you like dancing bears. And that's why we're showing you a dancing bear. So if you see something on your YouTube that you don't like, don't blame me. Okay. It doesn't put, if it's putting stuff that I like, it's fat old dudes talking about accounting. That's what I see on my YouTube. Okay. Was there another question?
It's about the color in your practice. Is the color in red or yellow should we pay attention to?
No, red meant something before it doesn't anymore. Yellow means it's the right answer, but these ones that were all red doesn't mean anything.
Okay.
Yeah.
So, yeah, and I also saw some practice midterm. Yeah, this one you are talking about is the second is the practice midterm 2 summer, but on the Canvas page we also have a second practice midterm 2 and a third practice midterm 2. Do we need to review that?
I would strongly suggest you do, yes. You should review all of the practice midterms for the chapters. So chapter 4 practice midterm, chapter 8 practice midterm, chapter 11 practice midterm, chapter 12 practice midterm. We didn't go through together, but you should look at that. Chapter 13 practice midterm, look at that. You should then look at practice midterm 1, 2, and 3, even though we only went through one of them. Yes.
Okay. So another question is, because you made some notes on your slides, so will you update the slides to the Canvas?
Update the ones from chapter 12. Yeah, I'm not going to get into the business of every time I make a mark on a slide, that means I got to post the new slides up because life is too short. But for that chapter 12 one, I will, since that was a significant amount of stuff. Question? Okay, give me a little time, guys. I will get that up there Thursday. And then it'll close on Tuesday just before class. Is that necessary? Yeah, I guess it's necessary because we want to talk about it after Danny's done, right? So yeah, so I'll close it just before class starts on Tuesday. Danny will come in and speak on Zoom here. And then after he's done, we'll go through the midterm, any questions, and then we'll jump in to chapter 18, and then chapter 24 probably we'll get to on Saturday, as we also, not this coming Saturday, but the Saturday after that, the 10th, right? As we also talk about Danny's presentation. And that'll be the end. Okay.
Okay. Sounds good.
All right, guys. Study hard. We'll see you on Tuesday. Make sure you show up for Danny's thing. Don't forget, you're going to have to take a picture to show that you were there, right? To get the 100 points for Danny's thing.
Okay. So basically, we will take a test before next Tuesday, and then we need to take a screenshot for the present in the class next Tuesday, right? That's the two important thing.
When you say take a screenshot of your, you're going to have to aim the camera so that I can see your name up there.
Okay. Gotcha.
Ken's. And you can, if you don't see your name in the first panel, there's a little arrow down there, and you can scroll down until you find yourself.
Mhm.
Okay? Question? Okay, guys, I will see you on Tuesday. Make sure you're on time, okay? Because I don't want my buddy Danny thinking I set him up for an empty Zoom session, okay? So make sure you show up, okay?
Okay.
Okay, guys.
Thanks, Sean. Have a good night.
You too.
Thank you.
Bye-bye.
Thank you.
John, I have a quick query to double check with you. So basically, sorry, and in fact, this sounds like I'm repeating, but I had a bad disconnection. Basically, the midterm that we're taking, available starting on Thursday, is everything that's after midterm 1, aka chapter 4, 8, 11, 12, and 13.
Correct. Not 18,
Okay.
whatever that other one was, 24 or whatever.
And 24. Okay. Okay. Cool.
Yeah.
I just want to clarify the parameter of my study.
Yeah, that's correct. Yeah, and that'll
Okay.
be our last exam. It'll just be the 2 exams. And so I'm revising the total number of points in the class down from 400 to 300.
Awesome. Okay. And as usual, if we go through all the midterm questions, like the practice midterm, all of them, we should be golden.
Yeah, I probably should have said this while the whole class was here, but that in-class example for chapter 4 is probably very helpful as well.
Okay. Awesome. And then another due dates coming up is basically we have classes Saturday. That's pretty much it.
Not this coming Saturday, but the Saturday after.
Okay.
It's the
Right. You're right. I'm still looking at your syllabus that's posted right now on Canvas.
Okay. So I say the wrong thing again. So
No, I just want to make sure I'm not going ludicrous because there's a lot of dates.
yes. So we've got class tonight,
Right.
and then yeah, now I feel like I'm losing it here. Why did I say Saturday?
So
Let me
scratch
make
out.
sure I'm no, wait a minute. Yeah. So yeah, it's what I said. So we had class tonight,
Okay.
29. Why do I have 2 Saturdays on here? I see the confusion. So 10-3, right, is Saturday, but you'll be taking your midterm
Okay.
over that period of time, and it'll close on 10-6 just before class starts on 10-6.
Cool.
So we're not going to have an official meeting this Saturday.
Awesome. Okay. I just want to make sure. Right.
Yeah.
Cool.
That's fine. And then 10-6, yeah, you got to be in class for Danny's thing. We'll start chapter 18. We may finish it. And then on 10-10, our class will simply be going through chapter 24 and anything left for 18 and talking about Danny's thing. You don't have to turn anything in.
Okay. Okay. But the final paper is due on 10/10, which I will later on refer to your the due dates you posted on assignments. But basically, that's how we feel as our personal reflection towards Danny's presentation, basically.
Yes, but you don't have to turn it in unless you want to for extra credit.
I will.
That's fine. Yeah, and I'll put up a rubric for that pretty quick.
Okay. All right.
It is.
Okay. No, I'm glad he's coming in to speak to us. So I will be there.
Yeah, you guys will like him. He's cool. He's
Okay.
very good guy, actually.
Awesome. Okay, I will stay tuned on all the updates on Canvas, and then check in with you if anything else comes up.
Okay, sounds good.
Okay. Thank you, John. Have a
right.
great night.
You too.
Okay. Bye bye.
Bye bye.